Hello from the Sustainability Action Society of the Capital Club in Dubai. I would like to wish everyone a good morning, good afternoon, good evening, depending on which part of the world you're in right now, and for putting the effort to attend this particular event. Today's topic is about global trends in sustainability. In 1987, the United Nations Brundtland Commission defined sustainability as meeting the end of the needs of the present without compromising the ability of future generations to meet your needs. Along the way, sustainable development goals were developed as a framework for improving the lives of populations and mitigating the hazardous human-made effects of climate change. These goals are based on the four pillars of sustainability: human, social, economic, and environmental. The last few years has seen sustainability take more significance in day-to-day and various stakeholder decisions for a number of push and pull factors: climate change, increased awareness, impact of higher social media penetration rates, public interest litigations, legal challenges, government regulations, and of course, consumer-driven actions. Today's panel comprises a pool of people with decades of practical experience in understanding and addressing sustainability challenges and opportunities across various industries, geographies, and cultures. Their backgrounds vary from advisory to investments to financing to portfolio company management. My colleagues will discuss what they have observed happening in the last few years and the global trends going forward. My name is Harbinder Singh. I'm a Singaporean with over 35 years international environmental experience across multiple countries and regions. I also invest in scalable circular economy companies. Aruna and Narayanan is a passionate sustainability champion who will moderate this event. Our panelists are Arun, Kumar, and Kelvin Chu, who are participating from Singapore. Arun Kelshiker, who is participating from Germany, and Karin Berardo, who is participating from Washington, D.C. Yuwun extends his apologies. He was supposed to join, but unfortunately could not this particular round. There will be an opportunity for Q&A after panel discussion. However, please feel free to post the questions during the panel discussion so we can come to that either or during the Q&A section, right? I'll ask my colleagues, starting with Aruna, to give a quick intro of yourselves, and after which we'll start the discussion. Aruna, over to you.
Thank you so much, Harbinder. And again, good day, good morning, good afternoon, or good night, wherever you're joining us from. Sustainability Action Society of the Capital Club in Dubai is very happy to bring you this very engaging session on global trends in sustainability. My name is Aruna Narayanan, and I'm the founder and chief impact enabler of Real Impact. And I'm joining you here today from the UAE, and it's going to be my pleasure to moderate this very interesting discussion. As we all know, COP28 was a milestone moment, and post that, the UAE has extended the year of sustainability into 2024. But today, sustainability is not just restricted to specific regions. I think we are witnessing different trends all over the world, and it's about time that we kind of cross-pollinate and share these expertise across the border so that we can all learn and in a way benefit from what sustainability and ESG has to offer. So today's discussion is exactly intended to do that. As you would see from the introductions, we have experts who are joining us from different parts of the world, bringing different variety of experiences. And through today's discussion, we will go through certain key aspects. One is we'll try to understand over the past decade, how has sustainability actually evolved to become what it is today? Then we look at what's happening across specific regions, and then we'll ask our experts in terms of what trends are they seeing and how can companies or countries, communities actually embed some of these sustainability best practices and in effect benefit from them. So without further delay, it's my pleasure to get this panel discussion started. And I would start with Arun Kumar, who is joining us today from Singapore. So Arun, welcome to this amazing panel, and thanks for being online with us. As a CEO, you have multiple roles that you handle. You have to oversee all the functions. How does ESG and sustainability kind of also fit in within that? And we are kind of eager to hear your thoughts on how have you seen this entire domain kind of evolve over the past decade. And if I can put you on a spot and ask you also about what about a bit of the negative aspects that are going on around ESG and a lot of people questioning this whole trend and is it really adding meaning and value? So, keen to hear your thoughts, Arun. Over to you.
Thanks, Aruna and Harbinder, and thanks thanks to the organizers to having me here on this panel. It's a very interesting and important topic for all of us. Sustainability is something from in the private equity industry we see it in the broader ESG construct. To me, S in ESG is social and also sustainable. So in terms of how we've seen the shift happen is that maybe 5-10 years ago the ESG awareness was more critical and having a ESG policy was very critical, but we have now evolved and gone into a stage of implementation, right? So now we're in a stage where the ideation, conceptualization, awareness, all of that is behind us. Right now, investors and all stakeholders actually want to see action. They want to see implementation, and that's the phase we are in right now. So I would say it's a marked shift in how ESG was dealt with, at least at a fund manager level. And I would say that still there's some way to go in terms of investment in people, process, and systems. There are definitely gaps, and I wouldn't sort of underplay that. Especially in the small and mid-sized managers. Fund managers who manage less than $10 billion have some way to go in terms of getting their act together from an ESG point of view. But clearly, the focus is on ESG, including sustainability. And we have integrated ESG into our entire deal life cycle, right from origination until an exit. We have to be focused on ESG aspects. And one point to highlight from a private equity point of view is that our holding periods tend to be quite long. We can have an asset anywhere between 5 to 10 years. So we take a long-term approach. It's a multi-year process. We cannot take band-aid solutions. We have to think about sustainability from a long-term perspective and have all the building blocks in place. So that is I would say those are some of the shifts that's happening in the private equity industry. Now, coming to the very important point about negative press around ESG, whether ESG is woke. We also saw a lot of capital being drawn from ESG labeled funds. In the private equity context, I would say a lot of this is probably more political, geopolitical kind of influences that is giving it a bad press. I don't think the nomenclature is the problem here. I mean, if somebody wants to call it ABC, I'm happy with that. But ESG is all-encompassing. It's a good framework. I think we all agree that it works. And I would only expect the focus on ESG to intensify in years ahead. So there will always be some noise, but I don't see that affecting the broader agenda around ESG and sustainability.
Thank you so much, Arun. And I think that's a good snapshot that you provided in terms of both, how it comes through and how it's evolved, and the fact that it is here to stay. And it's really up to us in terms of to cut the noise and focus on what it actually has to offer. Before I move on to Calvin, can you tell us a little bit more about your background and where you come from, and what's your kind of approach to this whole thing? And within your ecosystem, how is ESG really integrating into all the other functions?
So yeah, I'm Arun Kumar. I'm based in Singapore, and I'm a partner in ADB Partners. We are a mid-market private equity firm, which is which invest in growth-oriented firms. We are sector agnostic, but our region is Asia. So we focus entirely on the Asian market, India, China being the more important markets. But of course, we also have Southeast Asia, which is quite diverse, and that's where we invest. So, in my capacity as both COO and also CEO of the Singapore operations, I kind of take care of the operations of the fund, and I also look at all the functions within the fund, including ESG. As we were talking about it, the importance of ESG is just increasing, and obviously it's an area that we kind of focus on as a team. We are a team of 30 plus people sitting across 4 offices. Although ultimately ESG is something that I'm responsible for at the firm, but we collectively own this space. So what I mean by that is, from investment professionals to support staff, all of us have sort of ESG at the back of our mind. And as I said, through the entire deal life cycle, different parts of the team would get involved. But it's important that everybody has the sort of understanding and what is expected of us from an ESG point of view. So we do have dedicated professionals who focus on ESG, who are part of my team. But we also, have other members of the team who are fairly advanced in their knowledge in terms of how ESG has to be dealt with, right from diligence into making the investment and also when we exit. So we're past that stage of knowledge acquisition. Now I think all of us are fairly aware in terms of how to deal with ESG.
Awesome. Thank you, Arun. And I think you made a very valid point, which kind of clearly leads into what we like to hear from Calvin. So, Calvin, welcome again to this panel. It's a pleasure to have you. And as we understand, you're joining us from Singapore as well. And your experience spans across different industries and different sectors. And picking up from what Arun mentioned, that though there are ESG experts, ESG is something which belongs to every person and is embedded within different roles, and it's not just one person or one team's responsibility. You worked across different sectors and various regions, and probably you are seeing multiple approaches on embedding ESG within the business. So if you could start with a bit of a background about yourself and tell us what are these multiple approaches that you are seeing. And I'm sure it's not one size fits all. So we're keen to hear what are the different approaches that companies are adopting.
Sure. Thanks, Aruna, and thanks, Harp, as well, and the Capital Club of Dubai for having me today. It's a real pleasure to be here. Just by manner of introduction, I'm managing partner at Eden Strategy Institute. We are a strategy practice focusing on social and sustainable innovation. And our approach, I guess, is to help clients adopt systems thinking, capacity building, and inclusive business models in the space of sustainability towards just driving business for good. In the last year, for example, we've had the privilege of advising clients in the insurance, consumer, real estate, VC, and technology sectors with their sustainability growth strategies. I'm based in Singapore. I've also had the privilege of working with the Singapore government over the last couple of years to decarbonize the built environment, the logistics sector, and the maritime industry. So I guess I will respond to those based on our own exposures. I'll take this question in two ways, right? One is, I think, in terms of just following from what Arun was saying, what are some of the different functions in terms of how to interpret sustainability. And one of the major trends that we're seeing is that, let's say maybe 2 years ago, where companies were starting to maybe embrace sustainability and ESG on a more mainstream basis, there were people appointed to become the sustainability leads. This has evolved over time, and now many of them are being appointed as chief sustainability officers. Instead of, I think, the original preoccupation, which was really from a regulatory and reporting standpoint, producing a sustainability report, what we see CSOs do nowadays is to act as the center point of change, driving sustainability agenda across four or five different areas. For example, right from the top, they act as a counsel to the CEO and the C-suite, the board as well, to be able to drive compliance, sustainability strategy, stewardship, and really just the governance of the organization. Across, if you are talking about, for example, on the operations side, chief sustainability officers, we see them also driving operational improvements, energy efficiency, things like that. On the facility side, we see this happening. Certainly, the more engaged organizations are certainly have a responsibility, of course, to push in on investor relations and financing. So that's certainly there. But also, I think many of the more progressive companies are looking at ESG not only as a cost center or a regulatory license to operate, but also a potential revenue generator. So this is being pushed into product, into branding as well. So if you look across the multiple roles of how sustainability can be embedded across the organization, we see also that when it comes to different sectors, different industries, it is quite a mixed bag. So I'll run through a few examples if that's okay. I think if you think about the value driver for sustainability, and you look at let's say consumer industry, right? FMCG, consumer goods, we see that fundamentally there are changes in consumption habits, and companies are just all over it, right? From a branding standpoint, traceability. So there's not much issue here. This is really progressing quite well. From a technology perspective, I think the tech companies are naturally very innovative. Always, they need to be very competitive. So as we all know, I think technology, even data centers take up like 1% of all global energy usage. So there's also been a lot of innovation that tech companies are pushing into virtualization, things like power management, using AI for demand shifting or demand shaping, coming out with things like carbon-aware software, for example. So they've been on the forefront, differentiating their product, enhancing new revenues, differentiating their offerings. So that's very encouraging as well for these two. Similarly, when we talk about the built environment, a few years ago we started looking into this. Naturally, facilities managers are quite concerned about the efficiency and productivity of buildings. That's quite a established field, so there are a lot of building standards around looking into energy efficiency. There are new technologies like smart facilities management. Architects are also coming together. So also pretty good, very good, encouraging progress. On the other hand, we see some uneven progress, right? For example, let's say when we say finance, a topic that I think many of us here are very familiar with, while on the supply side, there have been many interesting developments like sustainability-linked loans, green loans, venture capital, and a bit of interest from, I think, family offices looking into impact investing. I think the return expectations and on the sell side, the range of options that are widely available beyond just ESG public markets counters, I think there's maybe some room to grow in terms of what kind of return expectations, how much discount rates and things like that. There are some sectors that we've been doing some work helping smaller businesses, logistics, maritime, SMEs basically, right? Where there's uneven pressure. For example, on the logistics side, certainly those doing business with European customers, with certain industries that are more tightly regulated, like healthcare or pharma industries. Some companies are seeing this as sustainability as a good differentiator. So at the same time, we have things like consumer behaviors, our own expectations of when we want our parcels to arrive, that is maybe acting as something that's holding back some of the more efficiency-oriented options that are out there. Similarly, on the maritime side, there are many good regulations that IMO are driving, but there are still technical barriers at the R&D stage that need to come together. So lots of sort of uneven progress, but on the whole, I would say we are probably living in a very good point in history where for the longest time, like 10 plus years, I think we were all like, is this going to ever happen? And now it's really happening. So it's a good time to be here.
Great. Thank you, Calvin. And I kind of can resonate to what you mentioned about uneven progress. So there's one domain which certain aspects which are like really accelerating, and there are others which are kind of gasping their breath to catch up. And I think also how it spans across different asset classes and how the journey has been for different asset classes is, something to be discussed. And I think that's where I would look to our next amazing panelist, Arun Kelshiker, who is joining us today from Munich. Hello, Arun, and welcome to our panel. And Arun brings with him more than 2 decades of experience in integrating finance, ESG, and a lot of other aspects, and also in his capacity as an investor. So Arun, if I can request you to provide our audience a bit of background about your amazing journey the past 20 years, and give us a bit of context on how has this whole discussion on ESG actually permeated across various asset classes. And just pick up from Calvin's point, is it uneven? Is it even? Is it fast, slow? Give us your insider perspective on that.
So thank you, Aruna, and my thanks to the Capital Club of Dubai, to Aruna and to Harbinder for very kindly organizing this, and also to my fellow panelists for sharing their insights. And as you shared, I was formerly the head of asset allocation portfolio strategy, so multi-asset for Standard Chartered Bank. But prior to that, I've spent the last 2 decades really on the investment side. So again, starting my career as a portfolio manager and part of that founding team for Allianz Global Investors, which is now one of the world's largest asset managers. And then obviously moving on to becoming a country CIO within the group, and then just focusing on that the spectrum of capital, going across various stakeholders and investors. And I share that as almost an introduction, because having seen that journey, having been a portfolio manager, having then gone on to sort of selecting best of breed funds that are focused in different areas, you see how things are developed, and especially across asset classes, having covered multi-asset. And so what we've seen basically, especially within the world of ESG, is while ESG has been around for a longer period of time than most people realize, and so, even if you think back to religious investors of the 17th century, they were screening out certain industries because they felt the values were not aligned with their own beliefs. So the Quakers and other religious groups were obviously screening out stocks and industries off the back of that. And that, in essence, is also a form of ESG that we're seeing today. So negative screening screening out of industries, stocks, and sectors is something that is an ESG strategy. If we sort of fast forward and talk a little bit more about what's been happening recently, and especially if we try and look towards covering asset classes, a lot of the focus has really been on climate over the course of the last 10 years or so. And that was catalyzed by Sir Mark Carney giving a landmark speech called Tragedy of the Horizon at Lloyd's of London. And he basically highlighted what was the impending challenges that we were going to face in our financial system. And he gave it at Lloyd's of London because obviously insurance was a very key part of that, but highlighting that the key challenges that the financial markets and financial participants to those markets weren't really thinking about the risks which were on the horizon with respect to how climate would dramatically impact that. And risk assessment was something which is was something that hadn't been covered in any form or fashion, especially in terms of climate. And off the back of that, we then had TCFD, which was launched in 2017. And since that time, TCFD has been a major framework, which I think is now applied across 19 jurisdictions. So potentially by the end of 2022, I think the figures are close to 60% GDP of companies are now covered by TCFD reporting, which is the Task Force for Climate-Related Financial Disclosures, and basically encourages companies to make climate disclosures along the lines of governance, strategy, risk management, and metrics and targets. And I kind of highlight some of the components because even as an investor 20 years ago, we think about ESG, so the environmental, social, and governance. But as an investor 20 years ago, governance was always a key investing facet when you were making investment decisions. So while governance has always been a very strong foundation, we've then had the additional pillars of environmental and social being added into what has become the overall construct of analyzing companies and making investment decisions. We also just want to put it into context of what's been taking place across investment markets. So essentially, we've also seen passive investing versus active investing, and we've seen that passive investing, because of obviously the more attractive pricing and the idea that it's challenging in certain markets and asset classes to regularly outperform those markets, there has been a big movement towards passive investing. But that being said, if you think about ESG investing, the majority of ESG strategies are actually focused on ESG integration, which in some form and fashion means applying ESG evaluation methodologies when making investment decisions, but more of an active basis than strictly speaking a passive basis. So while we've seen that the trend on the pricing and also on the investment side, on traditional investment, move towards passive, we've also seen the rise of ESG investing, but that's been far more in terms of active investing. And then just finally, the trend that's probably worth sharing is that there's a concept called the Bridges Spectrum of Capital, which was originated by Bridges in 2015. That's been developed and evolved, and now you have various iterations of that. The most recent ones being shared by the OECD, and that's basically talking about the relative merits of investing, both sustainably and traditionally. So on one side of the spectrum, you have traditional investment returns, And on the far side, on the other side, you have philanthropy and the idea that you've got, impacts which are far greater than just financial returns, societal returns, and also environmental returns as well. And alongside all of that, you've got various strategies that you then apply, including ESG integration, including impact investing. And so that spectrum is a good way of describing how certain different types of investors are approaching that. So clearly you'll see how impact investors fall into that part of that spectrum, which goes from financial returns across to philanthropy, as well as financial returns and financial markets investors. So that's the sort of evolution that we've seen over the course of recent years.
Well, thank you so much, Arun. And I would say I almost felt like I was on a journey and, seeing how the evolution and the trend happen. And I'm sure our panelists, our audience, and personally me, I can relate to what you're saying in terms of earlier G was probably the strongest piece in the whole thing because governance and structure and all what that was looked at. And now the E and the S elements are being looked at more seriously. And probably, all the three are coming to a point where they're getting enough spotlight and merit while it's not a perfect balance yet. And I think that leads us into our discussion with Karin. Karin, thank you so much. And thank you specifically because you're joining us from Washington, D.C., and it's probably an odd time in the morning for you, but pleasure for taking the time out and joining us. And you come from a very interesting background of more than 30 years in financing, but in financing probably conservation and built environment, and picking a cue from what Arun mentioned in terms of climate change and nature being actually now on the risk register and being looked at more seriously than ever before. Could you give us a bit of background about how your journey spanned out and specifically in terms of frameworks? The UN SDGs were launched in 2016 and it's kind of clocking its first decade in the next 2 years. Have these frameworks really helped in putting a structure around bringing that balance between, E, S, and G? And where's the whole, financing nature and conservation piece really playing out in all of this based on your experience? Over to you, Karin.
Wonderful. Thank you so much. And thank you, Aruna, Harbinder, and the Capital Club and everyone else. It's great to be here. So yes, I'm Karin Berardo. I'm the founder and CEO of Auburn Climate Impact Solutions and also co-founder of Integrity Global Partners. Today, I focus on providing sustainability advisory work to investors and project developers and industrial and corporate partners, and really bringing the perspective of having spent over 30 years focusing in sustainable infrastructure, first in real estate, affordable housing, renewable energy, as well as sustainable and regenerative agriculture and conservation. I've done this in over 50 countries, both in developed countries as well as in the global south. And moreover, in addition, I've been working in public and private debt and equity markets, so focused on working with investment asset managers, with engineering and procurement and construction companies, working in the development side. I've been with companies like the DC Green Bank, Fannie Mae, the Nature Conservancy, and in the GCC region, I've worked with family offices, as well as I was the first female CEO of a renewable energy finance company in ADGM. So it's been a long journey. I would say I started my journey in the early 1990s in the Brazilian Amazon doing smallholder farming and natural resources management and policy. And in those days, we really didn't have a sustainability career track. And so it's exciting to see what's happened over the last 30 years. And specific to the question on the SDGs, the Sustainable Development Goals are coming out of the Millennium Challenge goals before then. And really, I think, bring a nice anchoring and counterpoint to the SDG frameworks, and we need them all. What's important about the sustainability, the SDGs, is that they really provide a framework to anchor the discussion around both built environment spaces like housing and renewable energy and roads and the cities we live in, as well as natural spaces, farms, biodiversity, forests, the ecosystems that we depend upon. and how those two things, the built environment and the natural environment, impact people. So really getting in a little bit more, what is sustainable infrastructure? Like I said, the built environment is equally as important as the natural environment. We're seeing in the last few years a lot of focus on greenhouse gas reductions. We have to reduce the emissions. We have to address carbon. But fundamentally, if we address carbon but fail to address water, biodiversity, and poverty, we're still not going to have a livable planet. And so we need to be able to develop our ecosystems, our infrastructure in a way that balance the reduction of carbon as well as improving the ecosystems that we work in. And I think the SDGs do a really important job of bringing all of those elements together through the 16 SDGs. But it's not perfect, right? It's a little bit complex. There's a lot going on there. And fundamentally, what we really need through over the whole course of all of this is measurement, clear indications of what success is, clear indications of what is impact, and what is impact on the ground for communities, for projects, as well as what is impact for investors. And what is impact for the environment. So I'd say together with the SDGs, it's important to combine the ESG framework. We're also seeing more movement in things like the Integrity Coalition for the Voluntary Carbon Markets in providing higher standards to ensure the impact is measurable and fair. In addition to TFCD that was mentioned, we now also have the Task Force for Nature-Related Financial Disclosure, TNFD. And so that starts to bring in additional metrics in ways that we can look at the nature-based integration into our financial reporting and our non-financial reporting. And then, of course, the important work of the International Sustainable Standards Board and the IFRS standards, so that we can look at how to build reporting and how to measure the impacts. And that's going to be really critical to address some of the other concerns that have been raised around greenwashing and making claims that aren't supportable. We need good standards that people can look at and say, what does it mean to have E, S, and G? How do we actually measure that and demonstrate that we're making progress and, not just saying that we're doing good things? And so I think these toolkits help us manage the intersection between how to measure impacts on the ground and how to report and make verifiable claims of these impacts by investors and corporations and governments as well. And having that common language is a really important aspect of what we need to be able to do to continue to grow and expand this area.
Thank you so much, Karin. And it is, really interesting that you point out that we need to kind of focus on actions, but also on impact, and how do we kind of align, measure, monitor, and report this impact, and not just put a spotlight on a few problems that have taken headlines, like, for example, not only focus on carbon, but also look at reducing carbon and work on improvement of other aspects like water and probably waste-related systems. So it needs to be a balance. It can't just be trying to solve one problem. And I hear what you say in terms of saying the SDGs form a great framework because they are more holistic and they look at this whole scenario that we are all trying to address from a very holistic perspective, from the point of view of infrastructure, from the point of view of nature, from the point of view of people, impact, and the other aspects. And while the SDGs kind of unite us globally, I think I'd like to go to Arun. And Arun, understand from you in terms of in your introduction, you mentioned that you do have a regional focus within Asia. And I think it'll be really interesting to hear from you in terms of, while there are these global trends, what are you seeing specifically in your region and the regions in which you operate and invest in? What are you seeing as specific challenges, trends, in terms of policies, in terms of what kind of projects are coming up, and give us a flavor of what's happening in your region.
Sure. I mean, of course, Calvin can obviously add and give more color and perspective to what's happening in the region. From what we see, as I sort of mentioned briefly before, clearly, we are in an implementation phase, so which is a good improvement from where we were a few years ago. So that means we are actively looking at ESG challenges and also ESG opportunities, right? Earlier it was trying to solve some problems, but now these days we are looking at what are the areas we can proactively go out there and seize some opportunities and leverage those opportunities to build a better and a more efficient narrative around sustainability and integrate them into business strategies. So the one big shift that I'm seeing is companies proactively integrate sustainability strategy as part of their business strategy. It's not an afterthought. It is very much part of the business strategy. And firms are also looking at additional revenue streams, productivity efficiencies. So all of this are going to be good byproducts of integrating sustainability into the business strategy. So that's something that we are clearly seeing. And a lot of investments is also going into it. Now, we've seen large corporations come out with net zero goals by certain timelines. In fact, I think Microsoft said they will be even carbon negative by a certain year. So although we've not seen such big commitments or pledges being made by companies in Asia, but clearly they are investing in sustainability and renewable energy and EVs and other carbon reduction or mitigation strategies in sort of an anticipation of making a net zero commitment, right? Because we're going to have a top-down effect, because with all sovereigns making commitments in every meeting that's happening on the climate challenges, that has to actually trickle down, and that's going to become very clear. So countries are going to require companies to, in addition to measuring and reporting, they will want them to actually show and demonstrate what they've done in terms of achieving sustainability goals. So they are anticipating that, and they're already making the investments in the right areas. So that is another thing that we are seeing. The other big trend or sort of thing to highlight in this context is the significance of the green market. So by some estimates, the green market in Asia will be close to $3 to $5 trillion by 2030. I mean, we're talking pretty significant number. So this is going to be in decarbonization, in the climate tech. Within climate tech, of course, carbon tech has been the most important sort of I would say category or segment, but that is also changing. So we're going to see a lot more technology-related plays in the sustainability space. So these are some of the, I would say, the important trends that are happening in the Asian context, and companies are embracing them, and so are the fund managers, because when we set up an agenda for our companies from a portfolio management point of view, we have these active dialogues in terms of what is that they're doing and what is that we can do to add more value to their efforts. So it's a very collaborative effort, and we're seeing that gaining momentum these days. Yeah.
Thank you, Arun. So that's quite encouraging to know that it's in the implementation phase and there is active investment happening in these domains like carbon removal, shift to EV, and probably in the global south, just given by the kind of weather and temperatures we have, probably the adoption of solar is also a more viable option. So it's great to see that from your perspective, you're seeing a lot of action on implementation. And Calvin, if I can, ask you to kind of continue from what Arun was mentioning in terms of what's happening in the region. What are you seeing? Because you're obviously also interacting with a multitude of industries, with different sectors, with companies across different sizes, from probably large corporates to SMEs. So what's the trend that you are witnessing? Because as we all know that not every company is in the same point in the journey. There are some that have probably started 10 years back. There are some who are still a cat on the wall, trying to see if this is really worth it, or is this just an expense? Is it going to be just an additional cost to my company, or what's the benefit? So, Karin, what trends are you witnessing? And if you could give us some examples of which industries are reacting to this, how that will be really useful for our audience.
Sure. So thanks, Aruna. I think that's something I'm quite excited to also hear what the other panelists have to say as well. I would say maybe if we just think about it by countries first and then by company types. By countries, different countries, for example, Karin can also add to this later. US, for example, I think takes a lot more maybe of a market-based, market-driven solution approach, investing heavily in private sector investment in innovation. And if you contrast that as a region with Europe, for example, what we're seeing is that Europe, the EU is just a lot more progressive in terms of pushing out and getting buy-in around hard regulations, even extraterritorial regulations, taking stronger leadership with their ETS and their disclosure regime, for example. Whereas if you contrast that, for example, with China, I think their approach seems to be taking a much more heavily coordinated, centrally coordinated investment, very heavy investment in areas like EV electrification, battery solutions. And while there's still a lot of room to grow in modernizing their power grid, they're still building new coal-fired power plants. They have also been very just putting in tremendous investments in renewable energies. So that's really a bit of a contrast. And I think when it comes to developing countries, we see there to be an opportunity to, in a way, leapfrog the kind of investments, taking, I think, very much what Arun was saying, a 3P partnership kind of approach towards very practically solving material issues which are local to each country. For example, we did some work earlier late last year on water issues in the Greater Mekong sub-region. If we're talking about India, I suppose there are issues to do with droughts or waste management or deforestation in Indonesia, or other kind of floods and cyclones in the Philippines, or floods in Thailand, things like that. So different countries have very, very different material issues that climate issues that they are being affected with. And I think when it comes to these developing countries, the central government may have to take a stronger role than many smaller cities, in contrast with what we see, for example, in the US, where cities and states are actually taking the lead on many of these things. But these regional Southeast Asian countries, for example, while they're working very hard at the city level, many of them may lack the resources, and hence there's a heavy role for multilateral organizations to play a role. I'll speak maybe a little bit more to Singapore, where I'm maybe just a bit more familiar with. And in our very existential, resource-constrained approach, we, as a country, tend to take a more holistic approach, more business-friendly approach towards looking for opportunities, just as we are tending to some of the climate risk mitigation issues that we face as a country. We built industry blueprints for sector development. There's a tremendous effort and interest to bring on board SMEs to make sure that it's a just transition, not only in terms of our individual citizens, but also in terms of small businesses. There's a heavy push towards capacity building and education, job creation, giving tools to the ecosystem, giving grant support, while all at the same time, offering some degree of regulatory certainty that I think Karin talked about earlier, by way of reporting timelines, reporting standards, and also making sure that we are quite competitive. So I think the policy certainty is quite important in a place like this. But at the same time, in Singapore, to Arun's point, I think we're also very concerned about finding opportunity in this kind of discourse, right? Pushing into carbon solutions, tough tech, climate tech, carbon trading as a hub, looking into green finance, for example, or low carbon engineering buildings, green buildings, for example. So I think in every adversity that there is great opportunity, and companies, I think are also actively looking to see where they are. My own experience here has been that, certainly when it comes to multinationals and their regional headquarters, I think it differs, of course, a little bit by sector, as I talked about earlier. But I think most of them are no longer as we were in a couple of years ago, when they were still debating, should we have a sustainability strategy? These days, I think most companies have, regulatory wise, they have to report anyway. And as they're reporting, they're uncovering opportunities, risks, and baselines, and they are going through the process to see, okay, how can we incorporate our sustainability considerations and opportunities into our business strategy, exactly as what Arun was saying. And I think we are at a stage where even for the large companies, they are oftentimes I'm getting requests working through on actually just managing sustainability KPIs with business KPIs. For example, if I was to divert our resources into offering these new, say, products or disclosures or carbon taxes or shadow carbon taxes, for example, what's the implications it means? What implications do these bear by way of what my risk management department is doing, by way of my P&L, what do I have to sacrifice, what new channels do I have to incorporate this through, which other new consumer segments will I offer this to? So I think that the embedment inside the core business strategy into KPIs that can be thoroughly planned carefully, so we have a united, aligned movement in one direction. I think that's what I'm observing in the big companies. I think mid-market type companies, probably because they see the writing on the wall, and I think just a few days ago in Singapore, we some hard timelines were given for even private companies to increasingly have to do their sustainability reporting. So even mid-market companies see the writing on the wall, and they are also actively planning building capacity this way. And finally, I think the small companies realize that they need help, and that's the long tail that we have to elevate as well. So that comes through, as we said, things like training, awareness building, and just support, right? So it really differs across industries and by countries. But again, I haven't seen so much movement into this space as I have in the last 2 years, comparing that with the last 10 years. So good times.
Good. I think, Calvin, that was nice to kind of see how the activity is different at different levels. But the fact that everyone is seeing the writing on the wall, it's just that, maybe at each level, they are trying to decide when do they really want to take the leap. And kind of really like the point that you made, that it's not a sustainability strategy which is delinked from the business strategy. It's quite integrated. The KPIs are integrated, and the stronger that integration, the more value businesses will see in doing it. And it's not just one more tick box exercise. So Arun, Kelshiker, coming to you and leading into that conversation, you operate probably more actively in certain other regions. And what trends are you seeing in terms of adoption of ESG? And are there any specific red flags, challenges that you see, or are you seeing any specific opportunities that are quite distinct to the region that you are focusing on?
So thank you, Aruna. And so basically, being based in Europe, you kind of gives you a very clear line of sight of how various aspects within the ESG agenda are evolving. And just picking up on something that Calvin shared, in terms of the regulatory side, in Europe, we have something called the Corporate Sustainable Reporting Directive, which is CSRD. And just overnight, 50,000 more companies in Europe will have to report sustainability, or will have to make sustainability disclosures and report against criterion, which is above and beyond just financial criterion. So there is a big regulatory push in Europe, and historically we've seen that. We've seen the EU Green Deal, obviously the goal for Europe to be net zero aligned by 2050, and that has obviously had been accompanied by a series of regulatory disclosure filings, and that have been enforced on both investors as well as on corporates. So Europe has very much been at the forefront, or the leadership of implementing sustainability disclosures and really trying to move the needle with respect to sustainability. That's almost in sharp contrast to what we're currently seeing in the US, where ESG has taken on a very political meaning and a very sort of political phrasing. And just to share with you, so we've obviously heard Arun talk about woke capitalism, at the outset of this session. And, we've had Republican attorney generals sue their asset managers with respect to incorporating ESG strategies into investment decision making. So obviously a very sort of a very different view in the US, and off the back of that, we've seen asset managers having to leave or choosing to leave some of the major collaborative organizations that have been promoting positive movements in either with respect to climate and or other groups that are sort of focused on sustainability. But that being said, I think a few things that have given rise to these issues. One of them is definitely stems around fiduciary duty, or the responsibility of investment fiduciaries to manage those monies in the best interests of their beneficiaries and clients. And so again, there's a very different view which different parts of the world have taken. So within pension schemes, generally those are longer term investment horizons. Obviously, people will start their working lives. Many will contribute into a pension scheme over the course of their working lives, over the course of potentially 30 to 40 years or even longer. And again, there's a very divided opinion on what constitutes fiduciary duty. In Europe, in the UK, there is the idea that you do need to incorporate responsible investing criterion and characteristics when making investment decisions. And what you also find is to signpost that the government pension fund of Japan, which is the world's largest pension fund, actually embarked on responsible investing as early as 2015, and then sort of implementing in the years following that. So again, a very, very different take on fiduciary duty around the world that's currently being employed and voiced. And also just to share potentially also, different parts of the world are in different journeys with respect to their own economic development. So wherein the developed world is not as heavily reliant on building out energy sources or traditional energy sources, different parts of the world, emerging markets are far more focused on the energy transition. And so transition finances is something that's far more key in terms of emerging markets, and there's far greater focus on that area as an example. A project I've recently done with the University of Cambridge for the Commonwealth Secretariat has focused on how to catalyze sustainable finance for developing countries. And with the current model that we use, where the cost of debt is assessed with respect to the strength of a country's balance sheet, which is a very traditional and almost a dated model, you'll find that the poorest countries around the world have the highest cost of debt, and so are particularly challenged with trying to procure sustainable finance, especially from international organizations and development banks. So again, innovatively trying to look at how to address some of these challenges. Obviously, blended finance, which is has become far more has gained far more prominence with trying to mitigate traditional private markets investment risks by having concessionary capital, is something which people see a lot of potential with, especially in trying to address some of those current challenges. And just finally to share that obviously there's been a big focus when we talk about materiality. So financial materiality, events and or impacts to the financials of a company is something that has been accounted for when financial statements are shared. In Europe, again, there's been a big focus on double materiality. So not only the impact to a corporate and its activities and potentially its financial implications, financial materiality, but also the impact to people and plans as well. So incorporating other groups of stakeholders to try and best assess what is the overall impact or the overall material impacts, double materiality of a company and its activities to both people and planet as well as to its own corporate activities.
Thank you, Arun. And I think you've beautifully articulated the whole emergence of double materiality. And I think there are just so many terms now and acronyms that we have in the ESG world. It used to be CSR, ESG, TCFD, SASB, ISSB. So in terms of, you've just helped us, I think, understand and decode why double materiality is kind of gaining importance, and the fact that how this is panning out as a concept, maybe in the US, the geopolitical pressure, and in Europe, the way the uptake is. So it's really interesting to see how this topic that in a way binds us all is also kind of playing out differently in different regions. And Karin, if I can come to you, kind of leading in from what Arun mentioned in terms of double materiality and the focus on people and planet. You've done a lot of work around financing nature and conservation, and just keen to know more on how do some of these initiatives actually, kind of span out in terms of making it viable? Because one of our panelists definitely mentioned that at the end of the day, investors have to get their return back. So, what is the best way of financing nature and conservation? And you worked on a lot of high integrity projects like high integrity forests and wetlands. And how do you see this kind of really spanning out as a trend within the area that you operate in?
Yeah, great question. Thanks so much. There's so much to think about, and so many different ways of approaching the issue. And I think for a lot of what the first place we start is how can we actually create a revenue from conservation and from climate impact like investments. And so when we were working in renewable energy, we can have a price of power, a power purchase agreement. We can create revenues that way. Within municipal bonds, we might see affordable housing have revenue sources that are paying back the bonds. When we get into more esoteric questions like forest reforestation, regenerative soils, and some of the more complex questions of how to make a landfill or a carbon removal work, we are relying more and more on carbon credits. And those are a very important tool, one of several tools in a revenue toolkit that need to be looked at as either the only revenue source or potentially part of a portfolio of revenue sources to make complex projects work. Carbon credits have been under some stress in the last year, particularly in the voluntary carbon markets. And so, it's been good to see some strengthening around initiatives around the high integrity framework, the Integrity Council for Voluntary Carbon Markets, and also speaking to a comment in the chat around getting better and stronger methodologies around those carbon metrics, both in terms of how baselines are set and how they're measured over time, making sure that the standards are appropriate to the local setting, and improving the technology that we have available for monitoring and measuring impacts. So, carbon credits are a good tool. We probably need more compliance markets so that it's not all on the voluntary market. And we need more ways to support governments, in particular in the global south, so that they can sell and help manage some of those carbon revenues in accordance with achieving their own Paris Accord commitments. But carbon isn't the only strategy that we have. And I think when we look particularly at both conservation and at landscape level finance, there are a couple of additional solutions that I might want to highlight. One being the work that I was involved in sovereign blue bond debt conversions. And so I think there was a comment about, how to less developed countries manage kind of national level transformations. And I was lucky enough to be part of the structuring of the Barbados and Belize sovereign debt restructuring. So in those cases, there were countries that had very high interest rate sovereign debt. They were struggling in many cases, not just them, but others are struggling to fund basic needs, and thinking about, climate transition investments is very difficult. And so the debt conversions really help countries to issue a lower interest cost debt while also committing to put binding conservation commitments in place. So for example, in Barbados, I was part of the team at the Nature Conservancy that worked together with the Inter-American Development Bank. We issued a sovereign guarantee for new sovereign bond issuances, and that enabled Barbados to borrow at a lower interest rate to pay off their higher cost debt. And then in return for the guarantee that we issued, the government committed to conduct a comprehensive marine spatial plan for their entire exclusive economic zone, their entire ocean area in this case, to set aside 30% of their oceans for conservation and to fund independently managed conservation trust fund to support small businesses, local initiatives, and NGO initiatives for conservation. So really using the public market and the public sector, in a way to get money at the government level that would help do important planning work that otherwise was not going to get done, while also unlocking some capital in local currency to help stimulate the local economy and the local NGOs and nonprofits, as well as science and other initiatives, while also driving down the cost of debt for a less developed country. So I think that's a really important model. We're going to see more of those. I think one of the things that's also interesting to note in this sovereign blue bond was that in that case, it did align primarily with the international green bond standards, but we chose not to go ahead and get a second party opinion on it, because by having the Nature Conservancy involved in the structuring, the development and design of the project and the long-term implementation, it was viewed that all of those aspects were very well designed within the project in binding legal commitments within the project design. And so, the role of assessment and verification and validation had to be structurally integrated into the project. So that's one example. Another initiative that we're working on now is really trying to build out holistic landscape financing. And so this is really critical when we look at massive areas. We're doing this in a couple of regions in sub-Saharan Africa that looks at the interconnected challenges and opportunities of creating a green transition across 100, 200,000 hectares, 1 million hectares, really large areas where we're considering the interplay between investments in reforestation, household cooking and energy needs, because there are millions of people that can live in these areas, as well as how to finance industrial and commercial green transitions, small business funding for local populations, and regenerative agriculture. So within that kind of range or menu of activities that's going on, if we only invest in the highest IRR activities, then we're not creating resilient, sustainable transformations. And this is where blended finance is really critical. We need to look at all of the built and natural infrastructure within a region and create opportunities for both commercial activities side by side with building community resilience, with economic development that's going to have kind of possibly a slower impact, but really without improving the economic development, then we're not, just by creating some renewable energy for an industrial is not creating that long-term impact that's going to stabilize the community and stabilize the region for that in that case. So in this case, the challenge is really for many investors, if I'm looking at institutional investors, is they have traditionally been a little bit fixed in terms of what their asset allocation policy is. It's only the fixed income group or the infrastructure group that can come into these things. We need to work with them to understand what's happening at the landscape level. And by bringing in different flavors of capital, including concessionary debt, including sovereign, debt, credit enhancement, insurance, guarantees, grants, all of the different parts of the capital stack, that we can create really much more robust hybrid investment vehicles. And that's going to be required as we try and figure out not just, how do we address project development, project finance across the intersecting activities of these different areas within a broader landscape or a broader area.
Thank you, Karin. And I think it was, quite, encouraging to know about these lovely case studies that are actually on ground and that have worked, because ultimately, while we speak about sustainability, it's also about the E, S, and the G, which is the people, planet, and prosperity. So the revenue has to tick in so that we are sustaining these initiatives and they are not just good-looking projects on good-looking PowerPoint slides. So it's great that you shared the sovereign blue bond example with us, and the kind of echoing the fact that blended finance is probably the via media between funding and financing some of these initiatives and creating a more resilient infrastructure, because I think that's what we are all trying to lean towards. And we're getting a lot of audience questions, and we will keep a few minutes to take them on. But if I can just go to the panelists for the last round of questions and feedback. Arun, if I can come to you. I mean, you mentioned earlier that now, we've got the whole thinking about, is sustainability important or not behind us? We are more in the implementation stage. So is sustainability here to sustain? And do you think that it's now that we've actually hit the tipping point where there's a lot of action and momentum behind the whole adoption of sustainability and ESG across companies?
Sure. Thanks, Aruna. That's a very important question. I think my fellow panelists can also chime in. I think sustainability is here to stay. As I said, there could be some noise, there could be some negative press, and then there could be some other agenda. But I think we are, in a critical stage where it's come to a point where we need urgent action, prioritization. Not only at a sovereign level, but also at a corporate and other sort of functions or plays in the ecosystem. So that is going to become an imperative and not a choice. The reason I say it is here to stay is because increasingly the stakeholder engagement is going up, right? From asset allocators to regulators to shareholders, suppliers, customers. Everybody's ESG focused in some varying degree, and I think that is actually coming together, and that will really force people to think about sustainability and also take action in that space. So we are seeing definitely increasing stakeholder engagement. I also see a top-down and a bottom-up effect. The top-down meaning we are seeing countries making commitments, and so that is going to get pushed down to various levels. Whether it's the public sector or in the private sector, you're going to see all of that filter down. And likewise, the previous point I mentioned about stakeholder engagement is a bottom-up effect, because now, without being told, people are automatically focusing on sustainability. So we're going to see both of this play out, and they're going to converge, and we're going to have a lot more action in the sustainability space. And I'm also seeing a lot of regulatory changes, and quite swift. Arun earlier mentioned about CSRD, and I think some of the panelists also mentioned about ISSB standards. So the disclosure and reporting is going to become very important, and we're going to see a lot of the countries either take a lead or join other countries in doing so. I mean, recently Singapore made it mandatory for all listed companies to make climate-related disclosures from 2025, and even for large unlisted companies to start reporting from 2027. And coincidentally, Singapore also gave out the taxonomy on carbon-related energy transition mechanisms. So we're seeing a big regulatory push, and that is, of course, going to keep sustainability on top of our minds and agenda. And last but not the least, I mean, this is a bit of a private equity sort of angle, what I call the ESG premium. So ESG-focused managers are definitely going to attract more AUM. Okay, although we've seen some flight of funds from public funds, or publicly traded funds, in the private equity space, I see the exact opposite. People or fund managers who are more ESG focused definitely get attention, and larger asset allocators, especially institutional asset allocators, pension funds, sovereign wealth funds, all the large asset allocators who operate in an institutional manner, definitely going to require managers to be focused on ESG. So if you're an ESG focused fund manager, your strategy is very well differentiated. You don't have to be an impact fund. You can still keep doing what you're doing, but you have to do it incorporating the best practices from an ESG point of view. I think so. That is one aspect of it. The other aspect is from a portfolio company. Being ESG focused means that you are going to be getting a better multiple than the other non-ESG focused companies, and you will also get better access to pools of sustainability capital that is available out there. Large banks have announced sustainability frameworks, so there is plenty of sustainable financing out there, provided you are able and willing to tap into it. So these are some of the reasons I feel sustainability is here to stay, and we're going to see a lot more happen in the next months and years to come by.
Thank you, Arun. And that's, what do I say, quite encouraging to see that we've sustained sustainability till now, and it's probably going to continue sustaining for the next decade and more, because now is when the action and the implementation is actually starting. And probably it's now that companies and people will see a benefit. Probably till now, maybe a lot of them thought it's a trend. It's maybe one more passing concept, but it's definitely here to stay. And on that note, Calvin, if I can come to you, we've spoken a lot about financing and funding and environment and nature, but I want to, as we wrap up, want to ask you, what is your take on, is sustainability here to stay? Have we finally reached the tipping point where everyone's really sitting up and taking notice? And if you could share your insights specifically on the growing importance of S in the ESG, and it's probably easier to understand the governance and the structure. Nature, climate change, increasing temperatures, yes, tangible, we can get our head around it. Speak to us more about the S of the ESG, and how are you seeing this one?
Sure, yeah. So I think, is it here to stay? I would say that there are certain factors that have happened in the market that personally I felt a little bit demoralized with, right? When we talk to companies sometimes, and because of economic uncertainty, they may pull the brakes on some investments because of geopolitical concerns. They might be holding back, for example. There are sometimes risks of greenwashing that can maybe pose a threat to all the good work that everyone's doing. And even just thinking about the whole notion of shareholder primacy. For example, I think the last couple of years have been record years for big oil, and I think they've sort of backpedaled on many of the commitments they've made publicly in energy transition. So there are certain factors that are worth watching out for, to be sure that these things will not disrupt the sustainability agenda. But underlying it, if you think about what actually matters to business, the changing expectations of regulators and commitments of nation states, changing expectations of clients, employers, employees, and so on, the direction of capital where applied to sustainable innovations, because companies and innovators can see that there are revenues that are at stake. And also, I think maybe some regulatory aspects where companies have really committed to many of these sustainability initiatives. For example, through the Science-Based Targets Initiative, we've seen very rapid take-up on this gold standard for decarbonization, for setting targets, midterm targets in place. I think at last count, it was something like 127% uptake, I think, in Singapore, just year on year. So many companies are committing to it. So I would say that maybe on the macro, there are many good factors, although there are some aspects to watch out for. One of these factors, I would say maybe it's about the balance in looking at climate issues, environmental issues against governance and social issues. So I think you talked a bit about social issues, which classically are more difficult to measure compared to just the amount of, it's just kilowatt hours, it's just how many tons of CO2 equivalents. Social issues may seem to be more debatable in how we approach it. And I think therein people have hesitated a little bit. But I would say also I've been very encouraged with some of the recent climate work we are thinking. So if you think about social issues, fundamentally, I think in and of themselves, post-COVID concerns over health and well-being, mental wellness, diversion, equity, inclusion, safe and dignified work. I think these are some bag of social issues that have come to the fore, and many companies have to make sure that they're treating this very well. I would maybe argue that when it comes to environmental issues, even certain environmental issues translate into ultimately social issues. If consumers are boycotting your product, if employees are leaving you in a talent for war situation because your company lacks, say, corporate purpose. When we think about a just transition, for example, how inclusive are we when we are regulating or introducing carbon taxes? Or I think earlier Karin was talking about carbon credits. There are different flavors of carbon credits. Maybe coke stove credits have also an additional societal uplifting kind of element. So there are even, if you piece them carefully, a lot of social issues behind the environmental issues. Similarly, attending to social considerations, we found helps to really unlock the philanthropic capital. There's a lot of funding and a lot of multilateral and from the private sector and from foundations that want to be able to support the SDG goals. And in a way, sometimes being able to align the corporate agenda of ESG against what the social kind of impact factors, I think there's a little bit of a mismatch. Broadly, I would characterize it as maybe ESG lacking a certain language, primarily because a lot of the momentum around ESG came from the capital markets. Whereas if you look at the people sector into factors like, or even frameworks like IRIS, for example, social entrepreneurs, impact investors, non-profit organizations have been looking at tracking a lot of the kind of impact work robustly using peer-reviewed frameworks and metrics, actually for very much for quite some time. But I think that language has yet to really permeate into the classic ISSB reporting world. So there is some room to go to be able to speak the same language, and I think that would be something I look forward to help further sustainability as well. I think that's yes.
Thank you, Karin. I think you made a very valid observation that it's not all hunky-dory. There are still aspects that we need to align and match, but I think we all probably in that learning journey, and kind of each day as it evolves, we are trying to see how to make the whole process more robust and resilient. And on that note, I'd like to turn to Arun Kelshiker. And Arun, I mean, from your point of view, are we here to stay? Is it going to be, is the momentum just going to increase? What do we need to watch out for? And specific from your point of view, would be very eager to know, and I'm sure, marrying these two mega trends, I would say, of sustainability and AI, or ESG and AI, probably the two terms that are probably most used in the boardroom right now. Where do you see this integration, and what's your take on that?
So indeed, I mean, and I think it's worth, I guess, broadening the frame of reference. So it's not just in terms of a trend or a fad. I think ESG, sustainability, or however we end up defining the movement to incorporate other stakeholders, including both societal ambitions, as well as having a sustainable environment to be able to empower that. Are considerations which are becoming very much part and parcel of day-to-day operations. And I quote one example in, the British Standards Institute have now come up with a definition of the purpose of companies. And alongside the traditional financial returns economic definition, you've got the foundation layer, which is based on natural capital and planetary boundaries, which everyone is aware of in terms of the natural resources that we have, and then you have basically the pinnacle of what ultimately becomes a triangle, which is based on the well-being of society. So the fact that this has become very mainstream, and different people and parties are incorporating it, and as such this is an example of recommended guidance for the purpose of companies, then we know that it's definitely something that has tangible value, which will continue to grow and evolve. I think where we're challenged, and you sort of alluded to AI, obviously generative AI and ChatGPT have been fantastic tools, and the reality is that we do have those challenges across ESG in terms of having robust data, the quality of that data, how effectively, what's the value of the assurance behind that. I mean, I serve as an advisor for two ESG fintechs, Blue Onion in Hong Kong and Owl ESG in Los Angeles. And both are focused in different areas, but are using AI-driven machine learning technologies to try and drive what ultimately becomes better quality data sets, because we are still challenged with the idea that data gathering, especially on the ESG side, can be particularly manual, and that's a challenge which even the largest providers have and sometimes fall short of as well. So the idea of having high quality data to be available to make effective decisions is something that's really key. And if you think about where AI is currently being used for within the world of ESG. It's really in terms of providing greater efficiencies to this manual process of ESG data gathering. I mean, the amount of content which is around, which is shared, is vast, to say the least. And the reality is that when you talk about ESG and corporate ESG, others have shared their thoughts, but it's actually firstly about coming up with ESG strategies, but secondly also communicating it. And so where companies have worked hard to be able to deliver high quality ESG strategies internally, the kind of visibility and or how effectively that gets communicated to stakeholders and especially investors is an area that has been lacking, and one where AI and ESG basically come together very well, and almost an ideal solution to be able to try and address this very manual approach to driving high quality, robust data within the world of ESG.
Interesting. Thank you, Arun. And, that was quite an interesting perspective on how these two can actually create synergies and build that scale. And very valid point raised there on communicating how this whole journey is and communicating the strategy, because otherwise it just stays within the four walls and doesn't really permeate outside. Karin, if I can come to you and understand from your point of view, do you see the trend kind of accelerating from here on, and is sustainability here to stay? And where are your focus areas? Where do you really see the action happening from a future perspective?
Yeah, great question. I think ESG is a bit of a buzzword, as is energy transition and impact and nature-based and low carbon. But fundamentally, from my perspective, ESG is about identifying risk. And when we, frequently, historically, people have said, oh, well, ESG means that I have to accept a lower return because I'm doing something socially responsible or whatnot. Really what it is about identifying more robustly and holistically the different kinds of risk that your company is exposed to. And that these are both financial risks, which we have been measuring, and they're non-financial risks, which we haven't necessarily been measuring as well. So I think when we start to look at how companies look robustly at all of their risks and come up with methodologies to measure them internally and their impacts over the long term, not just the next dividend cycle, but how that long-term access to resources in interaction with communities, labor, global supply chains, and then can take steps to manage those risks, they're going to see that risk-adjusted returns are more appropriate because they are incorporating ESG. So I don't think that it's going away. Companies do need to think about all of these things. I think one of the issues is by not looking at it in a very robust way with clear methodologies, and without having good reporting mechanisms, as Arun was just mentioning, then you start to get into areas where companies either intentionally or accidentally may be doing greenwashing. So there are companies that want to do the right thing, but they're not doing it very efficiently, and that can have negative impacts on themselves, and it can also be a disincentive to others. So getting good information is really critical. Having third-party verification as appropriate, and transparent reporting is critical. And so I think really identifying those risks is important. The other thing I want to come to is that I think in many cases, the types of activities that might be happening in the infrastructure space, and I'll get back to sustainable infrastructure, is that they frequently can have externality impacts. And externalities, of course, are activities that a company doesn't have to report on, but they are having impacts on communities or further down the supply chain or somewhere, where the failure to understand them and measure them at a minimum creates a reputational issue for investors, but can also have very long-term issues on companies that fail to understand where their natural resources are coming from or where their exposure comes from. So one of the things that we do in working with investors and around projects is create a very comprehensive risk map using a 5-pillar strategy, but really identifying strategies, identifying robust set of risks, and then identifying strategies to mitigate those risks. So those might be in project design, they could be legal structures, they might be different, I mentioned guarantees and insurance products. So identifying the risk with your eyes wide open, and then looking again at the capital structure for how we can match the right blended finance solutions, part of the capital stack, to mitigate parts of the risk that we might want to pull out, that might be harder to mitigate, or there may not be a natural financial investor for some of those risks. Then that's where we would really tactically and strategically work with philanthropies and concessionary finance, making sure that the right risk-adjusted returns are matching for each partner in the investment and in the capital stack. So fundamentally,
Karin, that's probably, just picking up from what you mentioned, I think it's almost about picking the risk, studying it really well and investing the time and energy to do that and create the opportunity out of it, and then make it work where we get resilience as our, ultimate goal. I think we have a few minutes for questions, and Harbinder, if I can kind of direct one of the questions that we have from the audience to you, where our panelists spoke a lot about capital being available, but probably more projects that can be funded. But if we can take the liberty of picking a question where there's someone who's actually invested in a project, on a carbon reduction project in the landfill, but due to certain regulatory reasons or policy related reasons, it didn't really go the way it was planned. So Harbinder, do you want to pick that question and provide your response to it? Because I think it's also important we address not just the feel-good factors of sustainability and ESG, but also learn from some of the things that didn't really go as it was meant to and as planned.
Okay. You're talking about Anita.
I'm talking about Anita's question, that's right.
I'm almost 60 years old, okay, right? There are very few people, only a handful of people, okay, in my life that I've met that have been terribly passionate, right, to try and make a difference, okay? Anita is one of them, right? She pioneered a landfill gas project. At that point in time, carbon credits arose, because of this issue of viability gap funding, okay? For certain reasons, which is not appropriate to discuss, okay? What should have been there provided, at that point in time, didn't really monetize, right? And she struggled quite a bit. She, her husband, I believe her daughter is also there with her, right? There. I've seen her messages, and honestly, I have no idea what to really say. I mean, I think today, right? Given the fact that that you could have put in more things, right? In ESG, right? And the funding mechanism is more stable today. I would say it's more stable. I'm not saying fantastic, but more stable today, right? I think she wouldn't have gone through all the different issues that were there, right? But this brings me back to the next thing about it, right? Ultimately, right, somebody has to pay for these things, okay? I think we've heard all the speakers talking about, how sustainability has now become embedded into our way of life, into business decisions down the road, right? Okay, which is a good thing, right? People recognize that, right? But ultimately, like I said, love is free, right? But doesn't pay the bills. Okay, so the question is, how do you then fund these projects, right? I go back to Karin's point earlier on, okay, and she hit it very nicely, right? But ultimately, looking at identifying where different revenue streams are coming from. Part of the reasons why you have, for example, development of standards, right, which actually is quite nice because you help to flush out things, right, is you help to flush out the intangible to tangible, and through that, we try to monetize them in some form, okay, as a revenue stream to be able to justify getting financing for a project, right? We've seen now, that globally, right, there is funding available, okay, but it's it is largely driven by the private sector, okay? There's that. Most of the governments, right, you honestly, a lot of them do not have the funding in place. And most we see as regulatory, basically, I said earlier on, is, getting the private sector to get involved right on their own part, to fund initiatives to incorporate sustainability, right? You will see now the last one and a half years, okay, a lot of sustainability initiatives have focused primarily into energy, okay? And the main driver of that is because with energy, right, there's a very clear revenue stream, you see, that's there available, right? Hopefully from there, it'll start moving to other activities where the revenue stream is not so visible, okay? But maybe that's where blended finance comes in, okay, But Anita, I mean, in front of everybody, I'm telling you, you've been fantastic, okay, there's there. I understand where you're coming from, I know how to say, except maybe, you're just ahead of your time, okay, there's there, okay. So, yeah.
Thanks, Harbinder. And I think there's a lot of things for us to learn, and this that sometimes projects that have been ahead of time, just being pioneers sometimes doesn't help. Sometimes when you're an innovator and you're way ahead of time, and the structure and probably the kind of structure and intention that we see today from the investor side probably did not exist around that time. I have another interesting question, and I probably have two panelists answer that one in terms of how can ESG strategies, we've spoken about different domains which can it benefit. How can ESG strategies support the actual non-profit industry? Can funds that are in the ESG space actually support the other initiatives which are in the non-profit space? And this is a question that we got from our audience. I think, Calvin, if I can come to you, and then Karin, if you want to add on to that. So Calvin, would you like to?
Sure, yeah, thanks. So recently, for example, we were working with an insurer to plan their own sustainability strategy. And of course, classically, we would think about sustainability by way of, for example, their disclosures or their footprint or their finance emissions and things like that. In this case, as an insurer, I think we were also interested to see what is it that we could do to help them with their social strategies beyond just internally sort of negative filter type issues, but to see how they can contribute more broadly to the society. For example, in insurance, I think one of the common areas is this idea of applying your let's say CSR activities, corporate philanthropic activities, but applying it towards certain kind of let's say help-seeking behaviors. So as an insurer, of course, they should focus on their core mandate, their core competencies. However, there was also a room to play to get, let's say, partnerships with non-profit organizations to come together to be able to drive that kind of agenda. And we've done something similar like that in the healthcare space, in dementia, in lung cancer, in many different spaces across the region, where over time we've come to learn that non-profits actually have they're on the sort of the leading edge. They understand the needs. They're oftentimes in places where large corporations might not be there. So there's a lot of dignity and assets and insight that non-profits bring to the table. And I think the idea here is just how do we set up these corporate social partnerships to allow both parties, the corporations seeking their growth agenda and the non-profits seeking their impact agenda, and by that merit also the governments seeking their national agenda, political agenda and policy agenda, to come together, even though they use sort of different language, right? They speak to different interests, but all parties can really create this together. We've done several of these collabs where we bring 50, 60 different organizations together and in aging, in dementia, in fall prevention, in many different things like that. And actually we've seen a lot of really magic blossom when we can bring parties together. So I would say that as long as there is energy and the non-profits can be really carefully take stock or inventorize what are the unique assets that they bring, insights, connections, channels, and things like that, there are always ways to align. And for that, I'm quite hopeful.
Thank you, Calvin. Karin, do you want to give us your point of view on that one, and then we'll move on to the last wrap-up of the panel?
Absolutely. I think Calvin did a great job of identifying the way corporations might work with nonprofits to help meet corporate goals. I think in addition, nonprofits frequently, from my experience, do a really good job of needing to identify their quantifiable metrics and reporting that as in return for their grants. And they can play a really important role in kind of educating and aligning and delivering measurable impacts and outcomes. And so frequently as a sponsor of a project or an initiative, a nonprofit is really critical to use the language of ESG, be completely versed in the language of ESG so that you can report up and out. And that will be important to help investors and help corporate partners understand exactly how those impacts are going to align with their ESG reporting requirements. And so we do need nonprofits and others who sponsor programs to use the ESG language, use the metrics and the methodologies so that it's easier, unfortunately, for the investors to integrate those activities into the reporting that they're doing.
Interesting.
So Aruna, can I just throw just one final comment in for the question which came in, which I think is great, and one of it is really how non-profits can connect with with investors. And I think there are mechanisms out there which unfortunately they're not discussed as widely as they could and they should be. And I talk about, as an example, on the philanthropy side, donor-advised funds, or DAFs in the US. And so DAFs collectively annually gather close to 240 billion every year, because philanthropy is a big aspect of the US culture in terms of the tax benefits which people derive from that. So DAFs, donor advised funds, are a means by which there is capital, and non-profits can engage with organizations that are involved with DAFs, that facilitate DAFs, that invest on behalf of DAFs to try and procure some of that capital. And just also within the grant, I guess to share some other dynamics. In the UK, we donate approximately around 10 billion towards charities. The structures probably aren't as clearly defined as they could and they should be. But the idea of philanthropy and philanthropy being more focused not solely on making donations, but on actually achieving impact is something that's getting a far greater global voice. I mean, organizations like Philanthropy Impact and the Asian Venture Philanthropy network in Asia. I think there are some great organizations there that are trying to sort of bridge the gap and facilitate greater communication between stakeholders to try and break down these silos.
Interesting. Thank you, Arun. And as we wrap up the session, I'd go back to the panelists and ask them for their snapshot capsule, 30 seconds key message that they would like to share with our global audience as we wrap up the session. So Arun, can I start with you?
Yeah, sure. So if I have to sort of give some thoughts as we wrap up, I would say that take ESG seriously, because if anyone wants to implement a ESG program or sustainability focused agenda, just go all in, because there's no point committing to something and not being able to follow through on it. I think that's increasingly will become a problem. So I think important to take it seriously. I would say that there should be complete buy-in and commitment from the top management. The senior leadership has to be fully committed to the process, and that is quite important before you roll out a program. Both from a regulatory and reputation perspective, I would say, greenwashing, green rinsing, green hushing, green labeling, green crowding, green lighting, all of this, I would say stay away from it. These are not risks worth taking. And like I think my fellow panelist Karin mentioned early on, if you could inadvertently, if you don't do the right thing, I mean, you may have the right intention, but if you don't do it properly, it could seem as if you are doing some greenwashing. So that is something that you want to avoid. And I would say that invest in people, process, and systems to get this right.
Thank you, Arun. So Arun says, go all in and do it right. Calvin, can I come to you? What is your 30-second key takeaway message for our audience?
Today, I think we spoke a lot about risks as a real driver and regulatory factors, but I would maybe say that I'm very excited about the revenue side as well. So I would maybe, the best thing I can say is to focus on the holistic approach to business value drivers, whether they are about saving costs, driving new revenues, increasing the number of partnerships you have, reducing risks, compliance with regulations, employees, and so on. And in so doing, I would really say the approach that I've seen to be quite successful is to be firstly resourceful, look for partnerships even in non-traditional areas, to be creative, look for, challenge the status quo and look for different ways that you can reconfigure your operating model and your business models. And finally, really just to be tenacious. Don't give up. Thank you.
Yeah. So don't give up, be tenacious, and I think build unconventional partnerships. That's an interesting takeaway. Arun, Kelshiker, if I can hear your thoughts.
So I'm going to take it from the investor's perspective and invest with respect to how you want our future to look like. So basically, we talk about concepts like universal ownership, the idea that investors are buying a slice of the overall economy, but ultimately we're investing into what we want our future to look like. So invest in line with your values, in line with what you want your future to look like for your kids, grandkids, future generations. I think that's something that's really key. And also just finally to couple that together with obviously the fantastic opportunities which are prevalent with generative AI and using technology and embracing that to really try and maximize its potential and contribution to us achieving or collectively achieving our overall sustainable global agenda.
Yeah, thank you, Arun. So that's an interesting message. Invest in how you would like your future to look. So that's kind of, I think, gives all of us, as maybe whether you're a small investor or an institutional investor, a sense of put the money where you would like to see the future to be. So Karin, if I can come to you and hear your perspectives on what would be your key message for the audience as we wrap up.
Yeah, sure. I would say start where you are. We need all careers, professions, expertise. We need people in every kind of company, organization, and nonprofit and community. And so there is no one right way to do this. And there's no new career path necessarily that you need. I think that, the comments of make sure that you're in a supportive environment, sometimes you're going to be the leader and the catalyst to change that environment. And sometimes it's, looking for the small ways that you can make a change in the work that you're doing every day, in the community where you're living, and the people that you have an impact on. You never know where you might be having the impact. And then the second thing is, open your mind to an expanded way of looking at risk and really understanding the impacts or the unintended consequences or the other ways that any given action or activity may be influencing others, and particularly in the area of externalities, which we have kind of become used to not looking at. But a lot of this is, I think we're seeing a world where more and more externalities are going to have to be internalized. And it's important to kind of take off your blinders and look around to really understand how everything we do has a bigger impact, and there are ways that you can help address it.
Thank you so much, Karin. So that's a great takeaway in terms of take the blinders off and expand your view, and do internalize some of the externalities, because we are increasingly in a much more connected world. So something that happens in one part of the world definitely has the potential and, in a way, the risk to impact your business, irrespective of how far or disconnected you may think you are. So Harbinder, if I can hear your thoughts on what is your key takeaway. You've heard the entire conversation. We've heard different points of view, and what would you say are your key 30-second message?
I think there's no choice in the matter, right? And what's happening, right? I always tell people that people think it's good for the planet, good for few things, people, all that. But you have to realize that the planet has been around for 10,000 plus years, okay? It's been around for billions of years, right? It's been around for nearly 10,000 plus years, right? And the planet is a self-correcting ecosystem, right? Okay, if you don't learn how to respect it in some form or another, right? Okay, you basically get extinct. Yeah? This whole move of climate change, sustainability, right, is something where that's the end goal. Okay, we don't learn how to adapt quickly, how to find the financing for that, how to get the systems into that. Okay, along the way, right? All we're doing is what I call shifting deck chairs on a Titanic. Okay, like a better phrase, right? Like I just hope we all come to our senses, in due time, not so much for our particular people, our generation, but I think for the kids and the grandkids, right, for their futures are there.
Thank you so much, Harbinder. And on behalf of the Capital Club of Dubai, I'd like to thank all the panelists for joining us. I think we had an amazing discussion here. And I think most of us took the liberty of being candid. We shared real challenges, real problems. And I think one of the trends that we are witnessing where we are is just a lot of people are more inquisitive now about sustainability. If you go on LinkedIn, you have so many more sustainability jobs that show up. A lot of people are trying to see how they can maybe transition their career, because this shift, I think, in professionals wanting to look at this seriously is going to give us the capability to kind of make that shift and bring a lot of these strategies to life. And at the end of the day, when we speak about sustainability, it's all about the ability to sustain. I think that's really what it comes down to in the most simplest of the terms. So how can we almost support each other and build our resilience and our ability to sustain is what this is all about. I hope the audience enjoyed hearing these global perspectives from our amazing panelists in terms of what's happening in different parts of the world, what's happening within their industries. This is a very interesting conversation, very difficult to finish within a defined period of time, but I think we tried to do justice. And thank you so much for joining us. We will keep some of these series going on and bring in a lot of these insights to the table. Stay tuned and keep track of the space. For right now, it's Aruna signing off on behalf of the Sustainability Action Society from the Capital Club of Dubai. Thank you so much.
Thank you. Bye-bye.
Thanks very much, everyone.
Thanks, everyone.
Thank you.